Listen, we are live. If you are learning, if you want to learn rather, how to use the PE ratio when you're investing, you are in the right place. Welcome to the Sunday Playbook, brought to you by the Black Wealth Rebels. I am Jimmy. My partner Corey is with me. Kamari should be here soon. What's up, Corey?
I'm living to be the local, man. You know what I mean? Life is what it is. Life is good. Life is good.
Yeah. Oh, CT guy is here. CT guy. I guess he was trying to say Kamari said Amari, but Kamari will be here soon. But me and Corey are already here because we got a couple things we want to get into this morning. And the CT guy, again, I appreciate you because I've been reading that book this weekend. And for those who don't know what I'm talking about, CT guy is generally on our Friday show. We do a Friday live for those that don't know. We talk about everything, and he recommended this book right here. It's The Price of Oil, Stupid. So I've been getting into this book and it's pretty good. You know what I mean? I'm here for all book recommendations, by the way, as an aside. But this morning we are going to talk about the PE ratio. We're going to talk about what we're looking at this upcoming week in the markets. And as we generally do in our Sunday Playbook, talk about what plays we're going to make. Anything we say on here is for educational and informational purposes only. It is not investment advice. It's not trading advice. We do trade, we do invest, and we share what we do. And for those that are a member of our village, you already know that we share when we go in trades as well. I've been sharing, the trades that I make right in our village. And for those that don't know what the village is, go to blackwealthrebels.com. That is blackwealthrebels.com and join our village. We have multiple tiers, but we share our investments, we share our trades, and we just talk about, culture, talk about money. We talk about tax, real estate, Bitcoin, the whole nine. We have a Bitcoin 101 class coming up for 2025. Looks like people are voting that they would rather have it on the weekend. So we'll prepare for a weekend, get that scheduled, get that on the books. But yeah, go to blackwealthrebels.com to make sure to join our village, right? So Corey, man, how are you, good brother? Corey, you keep muting yourself, but how are you though?
I'm good, man, because I got a lot of shit going on in my background. That's why, I live on the boulevard, the Roosevelt Boulevard, and so the noise out here. If you don't know, it's one of the busiest intersection streets in the.
Yeah, Corey Crib is on the highway. For those in Philly, you know what the boulevard is, right? For those not in Philly, it's basically a highway. If you want to, keep it.
Yeah, and it's loud as hell out there, so I gotta mute my background because I can't block it for some reason.
No, it's all good. But listen, I want to get started with a couple things. First off, join the village, blackwealthrebels.com. For those you see, I got my hoodie on every Sunday. I come with the hoodie on. I go in, shadowy super coder mode where I'm ready to get busy with these classes and make sure we're doing a little bit of education. For those that aren't a member of the village, please join because a lot of the stuff that we do in the Sunday Playbook will eventually go just for the village. It's not going to be in the public, forum, but we'll continuously create things for the public. But at the end of the day, some of our plays and some of our thoughts concerning the markets will probably be back there because we're able to do more within the village than you do in the public forum. Because again, this is not investment advice, and I don't want none of y'all saying Jimmy told me to do this. Although I do want to say this, Core, I've been on fire lately. I've been on fire so much that I want to put a disclaimer out there. It ain't always going to be this way. I want to put that disclaimer out there because, I think I'm the last seven plays hit. The XLK play that I put on the channel went crazy, close to over 40, close to 50%. The Target play went crazy. Your Google play went crazy. I smacked SPY 7 consecutive times. And again, by the way, we're documenting all this for those not in the village. It's in the village. I say, though, I'm about to get in SPY. This is what I'm thinking. This is what I'm doing. I'll show you when I cash out. You know what I'm saying? So everything's being documented, but I just want to put that on the record, right? I tend to make a lot of good plays, and I'm going to tell you why. Someone said, man, how do you make so many good plays? And my answer to them is because I don't make a lot of plays, right? It's easy to get plays right when you're not all over the place. I don't trade everything. I don't invest in everything. I pick a small number and I make a small number of decisions. My strategy is making a small number of good decisions instead of just throwing things against the wall and seeing what sticks. So that's a personal strategy. You got to figure out whatever your strategy is. For those that are watching live, and we have a number of folks watching live, please let us know who's here with us live. Let us know who's here. I know CT is here. I see Thunder in the building. Good morning, Thunder. Appreciate you pulling up on YouTube. But whoever else is here, because I see we have more folks here than just YouTube. So let us know who's here. Let us know where you're checking in from. And we are getting ready to get into the class this morning. And for those in the village, you already know that This presentation, the presentation portion of today's class, will be separated out and put into under our options 101. This is about PE ratio, but we do use this within trading, but it's also relevant to investing. So keep that in mind as well. But Corey, you ready to get into it? All right, cool. Bet. Let's let me do this so we can get into the actual class this morning. Boom. In the words of Denzel on Training Day, boom. All right. So I want to make sure everybody can hear and see me. Can everybody hear me well? Before I start this, I want to make sure that everybody can hear and see me. Corey, you can hear me, right?
Yeah, you clear.
All right. Anybody in the comment sections, let me know whether you can hear me and let me know whether you see the presentation. Because I do have a presentation on the screen. I just want to make sure you guys can see it before I get started. All right. CT says, yep. Give me one more yes from the comment section and I'll get started on today's class. But I just want to make sure you guys can see the PowerPoint. I don't care who it is. Thunder, anybody else watching. We have a number of folks watching on both Facebook and YouTube. Just let me know you can see the presentation and we will get started. All right, let me do this too. All right. All right, Regina says yes. Good morning, Regina. How are you? All right, so this morning we're going to talk about the PE ratio, right? So it's called Decoding the PE Ratio, and it's the key to stock analysis. So this is our presentation on price to earnings ratio. This is used from a fundamental standpoint. And if you guys were in the last two classes, so the last class we did was fundamental versus technical analysis. If you didn't see those classes, make sure you go back and check those as well. In this, we're going to talk about the complexities of the PE ratio and how it's crucial in evaluating companies and making informed investment decisions. The first thing I want to start with in today's class is this. And I mentioned it the last two classes, and I'm going to mention it every class. And the reason I consistently mention this is because of the feedback and the conversations I have on a week in and week out basis as it pertains to investing. When you invest, you are buying equity in a company, right? You're buying equity in a company. It's not just a number that's just out there and it just floats on the screen. And you're like, people say I'm buying stocks. Like, no, you're not buying stocks. You are buying equity in a company. It's called a stock, but you're buying equity in a company. You are buying ownership of a company. I don't care if you buy one share. That's one slice of a large pie, right? But at the end of the day, you still have that slice. Why is it important to start with this? Because as we look at the PE ratio, this is just a metric that should be used in a bigger toolbox. But if you always go in with the framework that you're buying a company, you'll be better off in terms of knowing how to use it, when to use it, and why to use it, right? So always understand initially that you are buying equity in a company, right? Keep that in mind as we go through this presentation this morning. You're buying equity in a company. So the price to earnings ratio is a key valuation metric, right? So we use it in stock analysis. A lot of times we use it for long-term investing, but we also use PE just briefly sometimes in our trading as well, right? So it compares a company's stock price to its earnings per share. Again, going back to the fact that you're buying a company. All companies are in business to make profit. They create goods, services, whatever it may be, right? They sell those, they get revenue in, they have expenses, right? So they have profits. So understand you're buying a company again, right? So what you want to see is its price to earnings, right? You want to see its price to earnings. There's a couple things you're looking at. You're looking at the actual price that is trading for in the market, and you're looking at its earnings per share, right? And you're creating a ratio based on that. So you take the market price per share and divide by the earnings per share, right? So that's PPS divided by EPS. It's a simple formula, but it provides a standardized way to assess a stock's relative value. So you want to see whether a stock is overvalued or undervalued. This is a quick and dirty way to do so. Now, there's context in that, and we're going to get into that, right? But it's crucial for investors as it offers insights into market expectations, companies' valuation, and potential investment opportunities. You get all of that by looking at this one metric, right? You can see what the market expects it to do, how a company is being valued based upon its actual earnings, and whether there's a potential investment opportunity just by looking at this one calculation, right? So what a high PE ratio tells you is this, right? And I'll tell you high, I would say anything above 50 is considered extremely high. Low PE ratio, I would say 10, sometimes even below 10, right? But anyway, a high PE ratio indicates that a company's stock price is relatively expensive compared to its earnings.
Can I say something about that?
Yes, sir.
Industry matters when it comes to PE ratio because
that's part of it. You jumping ahead. But go ahead.
Sorry.
No, go ahead.
No, because you said, what a high PE ratio and what a low PE ratio is. So
Mm-hmm.
a high PE ratio is relative, and so is a low PE ratio. It's relative to the industry that they work in. All right, now I'm done.
Yeah. So if you're looking at the overall market, you can take a certain metric, but Corey is right. And I could jump into that now, as a matter of fact, Corey. So I thank you for bringing it up, right? This is industry specific. So you wouldn't want to compare the PE ratio of a tech company to the PE ratio of, say, a retail company that's been around for 50 years, right? You wouldn't compare the PE ratio of McDonald's to the PE ratio of Amazon or NVIDIA. You definitely wouldn't do that. Now, you would compare the PE ratio of a tech company to a tech company and of a retail company to a retail company. That you would do. But just as an overall metric, even if it's within this industry, it still can be considered high in the grand scheme of the market, right? But here's what you can just get from looking at the PE ratio. A high PE ratio indicates that a company's stock price is relatively expensive compared to its earnings, right? So this could mean that there's strong growth expectations. The reasons you see those high numbers within the tech sector is because people believe there's more of a chance for growth within that sector versus other sectors. Now, what you really are looking for is whether it's valued, right? Overvalued or undervalued. So potential overvaluation, you want to see if something is overvalued. Looking at the PE ratio can indicate whether it's overvalued. So if I'm looking at tech companies versus tech companies, and all of the tech companies have a PE ratio that are similar, but then one has a PE ratio that's extremely high, you may want to dig a little bit deeper to see if it's being overvalued, right? But the PE ratio could also teach you about the market optimism and future prospects. A lot of times when you see with startups or newer companies, you see they'll have a high PE ratio because it's not about what they're currently producing. It's about their future prospects. Because again, we're talking about how much are you paying for a dollar of their earnings, right? We're going to get into that in a second, but that's kind of like what the metric is telling you. So if I have a PE ratio of 20, I'm paying $20, right, for a dollar of your earnings. That's the potential is. Now, a low PE ratio, right? And I said 10 being the base of a low PE ratio, but again, depends upon what you're comparing it to. And good morning to our brother Kamari, who's in the building. A low PE ratio indicates that the stock is relatively cheap compared to its earnings. Now, cheap is not always good. It could be undervalued, right? But it also could mean that there's not a lot of growth left in that specific company and or industry. And it also could be that there's market concerns about the company's future. The reason I started this off with talking about the fact that you are investing in a company is because you can't just take the PE ratio in a vacuum and make a decision. I would never do that, whether we're talking about investing or trading. Never look at the PE ratio in a vacuum and then make a decision. So a lot of you guys already know professionally, I work in data science and I write models. And what I'm doing is I'm always looking for variables that give me more information. The one thing I'll say about the stock market in general, and this is trading and investing, is there is no one formula that you can plug certain variables in and get a decision that this is great or this is good, right? You can't look at anything in a vacuum, anything within one specific model, because when you talk about the market also operates from the standpoint of emotion and not just data. So you can use various metrics together within your own kind of strategy to make a decision, but never look at one metric. If someone tells you to look at one metric and make a decision, either they're a liar or they're not telling the truth. It's just one or the other, right? So the fact of the matter is understanding all of the different things that we're going to bring within this series of classes and then figuring out which ones you want to use to make your decision. That's how you make an informed decision. But there is no one key model. I don't care what anyone tells you, unless you work at Renaissance Capital. But anyway, but that's either here or there. Kamari, how are you, good brother?
Good morning, people. How y'all doing?
All right, man. I just want to make sure you put your voice on the record, man. That makes the women come into the class. So
stop it. That's a lie.
I just want to make sure you do that before we move on. I just want to make sure Kamari.
Women could care less. They want to hear from you like Jesus with all the curly hair.
No, I'm in super. I'm shadowy super coder mode. I got the hoodie on, man. Every Sunday I come with the hoodie, man. But anyway, so let's keep going about the
I like that.
But understand that you can look at this number and it gives you a lot of information, but you have to dig a little bit deeper. It's why in previous classes I talked about actually sitting on earnings calls, studying specific companies. It's also why I am a big believer in keeping things simple and not investing in a bunch of companies, but a small number of companies and kind of like, digging deeper within those companies as opposed to expanding wide. I understand the idea of diversification. I'm not saying don't diversify, but what I'm saying is if in order to build wealth, you have to be concentrated. That's my personal opinion. I don't know how you brothers feel about that, but my personal opinion is you have to be concentrated, but you have to also put in effort and energy. If you
That's
guys,
a fact, Jimmy, by the way. That's a fact.
There you go. There you go. So if you guys are going to get into this space of investing and trading, I think that you have to make a certain commitment from a time standpoint to really put in, do the knowledge, so to speak. Because if you're not going to do the knowledge, if you're not going to be willing to see what the company is doing, then you're better off just, getting a 3-fund portfolio, go buy the S&P 500 and a couple other funds and just going to mind your business and be completely passive about it. But if you want to get into this space where you want to trade and be an investor, you got to, allocate some time to doing so. You can't just, go buy these stocks and these companies, because a lot of people will tell you, go buy the things that you like. That's not always a good idea to buy the things that you like. You have to understand what's going on with the company, which is, again, why I started off by saying you are investing in a business. I've told the story before and I'll tell it again. The simple question that I have to everyone when they talk about buying a specific company is, how does that company make money? It's a simple question. It's nothing complex. I'm not asking for any formulas. How does that company make money? If you can't answer that question, then you have to either really ask yourself, why are you investing in that company, right? And I've told the story before about when Enron was going crazy, because, again, I'm old and I've been investing for a long time, but I was around during the Enron days, and Enron was shooting through the roof, and I wouldn't buy it. And people would say, why aren't you buying it? It's going through the roof. You don't understand it. You understand that you got to get into this. And I'm like, how does it make money? No one could ever answer that question. And the reason that no one ever can answer that question is the reason I ever invested in it, right? Even when it pertains to Bitcoin. When I first heard about Bitcoin, I just threw it to the side because I didn't understand how it makes money. That was before I did the knowledge and realized that Bitcoin is money. It's not a company, right? So it's treated a different way. This isn't about Bitcoin, so I digress. But the point is, if you're invested in a company and I ask you that one simple question, how do they make money? And you can't answer that question, we have a problem. We have a problem, because at the end of the day, that's what a business is here for. They're here, right, to make money. They're here to provide a good or service, and they get compensated for that. And how they use that compensation and how they grow that company is really what we're talking about, right? So another thing about the PE ratio, if you have a company that's, really scaled and it's an older company that pays a nice dividend, their PE ratio more than likely won't be as high as a tech company, a growth company, as Corey mentioned. So make sure you're comparing things that are similar in terms of the industry and the type of organization that we're talking about. Make sure you're doing those kind of comparisons. So a high PE ratio, again, indicates substantial anticipated earnings growth, and investors are willing to pay a premium for expected future performance. It's why you see a lot of startups, tech companies with these higher ratios. It's not that they're bad companies. It's that I'm willing to pay a premium to ride with that company because I believe that they're going to grow, right? Now, a moderate PE ratio suggests steady, moderate growth expectations, and the market anticipates consistent but not exceptional earnings, right? So I know that on one of our future classes, we're going to talk about dividend kings, because that was something that was asked of us. And, we'll get into a lot of that conversation there about, something that's a dividend growth stock versus just being a dividend stock, right? A lot of times people that want to invest in real estate use the REIT method. And by the way, we also have a REIT class that's done that we're going to be bringing to the folks that are in our village. By the way, go to blackwealthrebels.com to make sure you're a part of our village. If you haven't joined, we have multiple tiers. There's a free tier, there's paid tiers. But go to blackwealthrebels.com and make sure to join, because we have a REIT class as well. But I'm bringing that up because a lot of times REIT are a strict dividend play, right? And you'll see those have lower PE ratios, but it's strictly about the dividend within those companies, not necessarily the growth of said company. Now, a low PE ratio may signal limited growth expectations, but it also could mean that the company is undervalued. That's why you just can't take this metric in a vacuum and run with it. It makes you dig a little bit deeper. When I find this low PE ratio, am I finding a gem? Am I finding an undervalued company in comparison to its competitors? Or is there still no growth left? There's no growth here, right? That's what you have to figure out. That's why I say you can't take this in a vacuum. And I'm getting ready to make a statement that's going to be kind of controversial because a lot of people hate when I say this, but I actually believe it's true. Dividends are overrated. I had to let that breathe for a second, Kamar, for dramatic purposes. But but dividends are overrated. Now, I've read several academic articles on both sides of this argument in terms of dividends being overrated. and dividends being kind of undervalued, right? So, but my opinion, after doing the research, after doing the knowledge and looking at both sides and going back and doing some testing, I believe that in the grand scheme of things, dividends are overrated. And I'm explaining to you why. Probably should save a little bit of this for the dividends class, but I think it's important to talk about within the PE ratio too, because if you're looking for a higher dividend company and you see the low PE ratio, then, you know, it's why. Here's why dividends are overrated. When you invest in the market, the objective of investing is to grow your capital. We're talking about growing your capital, right? And a lot of dividend companies, specifically strong dividend companies, don't have a lot of growth left in them. That's why people look for the specific dividend growth companies. That's like a whole thing that people look for, try to find a little bit of both. Because if you have a high dividend company, a lot of times there's no growth left. So to me, it's overrated because most of the time when you pay me a dividend, I'm reinvesting it anyway. And I've done the numbers and done the math. A lot of times with those companies, even after reinvesting the dividend to say buy more shares, right? I'm still not outperforming high growth companies. Our entire economy has changed over the last several decades. If I go back and look at the S&P 500 in say the 1980s, right? It was all oil companies for the most part, all oil companies. I look at the S&P 500 now at the top of the food chain in terms of the top companies in the S&P 500. It's all tech, it's all data and tech companies, except for Berkshire Hathaway, right? That's the only one. But for the most part, is tech companies at the very top. So I say that to say that our economy changes over time, and what happens with the tech companies becoming so prominent is they have high growth. I'll give you a personal example that I've shared before. I had a gentleman who was one of my mentors in the stock space tell me about Amazon damn near 2 decades ago. And I laughed at him and told him, like, why would I buy stock in Amazon? They sell books. And I'm going to tell you my argument at the time. And again, I wasn't as seasoned as I am now. I told him, I said, once Barnes & Noble goes into the digital space, Amazon will be out of business. I had no idea about Amazon's future plans, what they were working on, because at the time I didn't understand how to listen to earnings calls. Like, and as a matter of fact, it wasn't as simple back then. I told you guys I'm ancient, right? So everything wasn't online the way it is in 2025. So there's actually an advantage. This is an amazing time to get into the markets because you have access to so much information. You can do everything from your phone. This was at a time where you had to actually go into a brokerage and deal with the stockbroker. But anyway, I digress. Point being is Amazon's PE ratio was extremely high because they weren't making a lot of money. But what I didn't know is I didn't know that they had AWS in their back pocket and they were building out the infrastructure for that. I didn't know that Amazon didn't even consider themselves a company that sold online books. They were a logistics company. All of the things that they were building in the background is what makes Amazon Amazon today. But because I didn't understand how to do the knowledge at the time, I was just looking at how much money they earn, right? Which is why, again, you can't look at PE ratio in a vacuum, because if you're looking at it in a vacuum, you're comparing its price to what it's earning. But if you don't know what the potential of that company is, then it's a problem. Another example I'll give you from the real estate space, because this actually happens in real estate. I had a deal before in a quadplex, a 4-unit apartment building, and the person was selling it. And when I went to see the property, I realized there was a huge space in the bottom of this quadruplex that wasn't being used for anything. He had 4 apartments above. He was selling the apartment based on the income from those 4 units. I told my partner, I said, yo, we could take this space down there, putting some paid, laundry kind of stuff, and that's a whole other income stream. Right. So this is just a true story. We put some laundry stuff down there, some vending machines, created a whole other $20,000 annually in income just based upon that. And he wasn't valuing the building for that potential use of that space. Right. So him not doing the knowledge and understanding that there's more value there, he made a decision. For us on the other side, we said there's more value there. So if you look at a company and you feel like this company has a lot of potential of another line of business, and a lot of times by listening to the earnings call, you'll hear them talk about that. And you have to figure out whether that's factored into the price or not. Those are just some quick examples from real life that I've seen. I'm looking at CT Guy's comment. And I know that a lot of people would disagree with that because there's certain people out there that is their entire thesis is about dividends. He said, you lost me on that one. Dividends are overrated. My portfolio of reinvested divvies would disagree with you. Reinvested my Apple divvy since 2008. And those have split a couple times, right? So that's Apple. But now if I give you a growth company, I can give you several growth companies that will have outperformed that over that same time frame, right? So here's an example. I know Nvidia. Someone look right now and tell me what's the PE ratio on Nvidia? Right, I know it's probably high, and it's been high for a while because people are willing to pay a premium to own a company with that much growth. If you look at Nvidia from that same time frame, since 2008, right, without a dividend, how would that have performed against your Apple? And I know I'm cherry picking. I get that, but I can name you several companies, right, that if you would invested that same money in without a dividend, you would have outperformed your Apple. And there's nothing against that. Listen, a great investment is a great investment. I'm not saying don't buy a dividend company. That's not what I'm saying at all. And as a side note, many people believe that Apple is a dividend growth company and not a strict dividend play, right? There are other companies that you're buying strictly for the dividend.
Now, Jim, NVIDIA's PE is 56.86 or 57.
Okay, 57, right? Yeah. So someone said that that's kind of high. I looked at NVIDIA maybe about a couple months ago. They were all the way up. Their PE was at a 70 at the time. So it came down a little bit because I guess the price, but it was at a 70 at one point, which is insane. But that's what people are willing to pay for a piece of NVIDIA. And shout out to Jamil who put it in the chat, PE 57.01. All right. Now, who would you say is NVIDIA's top competitor if you guys had to pick a company? Right. I know a lot of people would, when I ask this question, most of the time people go to AMD or something like that. Look up AMD for me, Kamari. What's AMD's PE ratio?
I might say Intel, but for top
let's look at both of them. Let's look at Intel versus NVIDIA versus AMD live on air while we're here. For those watching the replay, shout out to you.
How do you want to see it?
Huh?
When we put it on screen, how do you want to see it? Or you just want me to give it to you?
You just give it. You can just get pause, but you can just give it to me.
That was not pause worthy, sir. We've been fighting over this pause thing all morning, y'all.
Yeah, no. That sounded crazy.
I know. I'm just telling the truth.
CT guy says AMD, and he also says Taiwan Semiconductor. But and you say Intel, so we can look at all of them. So right now,
Semiconductors is a they like a shell company. Like they got a lot of action. Like they got a lot of clientele, but
let's look it up though. Let's just look it up. Let's see what the PE ratios are of all these companies. Nvidia is 57.01. Someone in the chat, while Kamari do either one. Someone in the chat put in AMD. Look up AMD and tell me what their PE ratio is and put it in the chat. Lorraine also says Intel, AMD, and CT guy says Intel is a dinosaur. They'll never catch up. And guess what, CT guy, you're not alone in it. I've heard a lot of people say that. So, so Jamil says
never know.
He says Cisco's PE is 25.26. So people are willing to pay 25.26 for $1 of the future earnings of Cisco, right? People are willing to pay 57.01 for $1 of the future earnings of NVIDIA. Doesn't mean that one is better than the other.
So NVIDIA's PE is 54.06 from this one spot. I know I said 57 a minute ago.
Well, I was looking at what Jamil put in the chat. So I don't know, AMD's PE ratio actually has a higher PE. So look at this.
Yeah,
AMD's PE is
yep. And then Intel has a negative PE ratio of negative 5.31.
So guess what? With them having a negative PE ratio, that means that the market overall is kind of agreeing with CT guy. They're not willing to spend $1 for a future $1 of Intel's earnings, right?
But that could be a great play right there.
Could be, but it also could be telling you something else, which is why you don't look at this in a vacuum, but it's giving you information. And as you can see, you can look at this number, get a little bit of information, and then figure out, okay, this is what I got to go research. Is CT's assessment correct? That they're a dinosaur and they'll never catch up, which is why their PE is what it is? Or is Kamari saying that it may be a play there? I don't know what they're doing, what they're building. This is where I would go look at their 10K. I would actually go listen to their earnings call. I would do research. I would do the knowledge, but I would get the information just by looking at this PE ratio briefly and then going from there, right? Having a negative PE ratio as well. Now, again, their companies, I don't want to put my personal business out there. There's a company right now that has like a negative PE ratio that I'm irresponsibly long on that company. And it's because I see what they're building though, right? I'm inside seeing what they're building. So, but again, that's doing the knowledge. It's not just making a decision based on said PE ratio, but I digress. Let's move on forward. So as Corey Brown mentioned, right? Compare PE ratios of different companies within the same industry to identify potentially undervalued or overvalued stocks. Now, banks generally, I say generally because sometimes things change, because what you call fintech, some will call a bank, but banks generally have low PE ratios. But sometimes within that, I remember years past, I made a nice play. I made a nice amount of money on Wells Fargo, because it's right after 2008 when everything was going crazy. One of the things I looked at was their PE ratio in comparison to other companies, and I knew that they wouldn't go away as some of the other banks did. So, but I was comparing it to banks. I wasn't comparing Wells Fargo to Apple. I wasn't comparing Wells Fargo to Microsoft. I was comparing Wells Fargo to, hear this one out, Countrywide. Rest in peace, Countrywide.
Actually makes sense.
Rest in peace, Countrywide. Countrywide is now with the ancestors, but I digress. So
not with my ancestors.
The Countrywide is no longer with us, but I digress. All right. So historical analysis: track a company's PE ratio over time to understand its valuation trends and market perception and changes. So again, we just talked about NVIDIA. I talked about how when NVIDIA was extremely hot, the PE was 70. Now it's 50. So it's cooled a little bit. But again, look at it in comparison to its competitors. It still looks a little bit different than Intel does, right? And we looked at that live here this morning. And by the way, Taiwan Semiconductor, they also have a better prognosis of the Intel based upon the market sentiment with PE ratio. People are willing to pay $32.30 per share for part of its future earnings, right? And by the way, this idea of looking at the price per share and the earnings per share and they're giving you a number, right? So that number is also what's considered in the industry a multiple. You'll hear people mention the word multiple, like it's a multiple. What's the multiple of that company, right? A lot of times you'll hear this on Shark Tank. If you look at Shark Tank, when they're valuing small businesses, they're looking at multiples. How much, looking at your earnings, how much am I willing to pay for those earnings? So that's another way to look at it. And another way to look at the PE ratio is this. If I have a PE ratio of 32.30, such as TSM, it's also saying that all of the investments in the TSM, based upon its earnings, it would take about 32 years for it to pay back all their investors based on its earnings. It's a whole other way to look at it. So Jamil said, Countrywide was my main lender back in my mortgage day, RIP. So when he wrote mortgages, listen, everybody was writing Countrywide mortgages because they was giving out money like it was nothing, which is why they with the ancestors, like the corporate ancestors. Shot the Blockbuster. They with the corporate ancestors too, but I digress. Industry benchmarking. Use industry-wide PE averages to gauge a company's relative position and identify sector-specific trends. Corey brought it up earlier, and I said it was later, but I'm glad he brought it up when he did, because we can reinforce that, because I think it should be reinforced over and over and over again. Don't sit through this class and then start comparing the PE ratio of McDonald's to the PE ratio of NVIDIA. Two companies doing two separate things at two different stages of their life cycle. So compare apples to apples and oranges to oranges.
Now,
so
Jim, I want to
go ahead. Add in whatever you want to, good brother.
So everything y'all been saying is right. I will say this, though. The whole market has a PE. I'm sure you mentioned that already.
I did. I started with it.
And you can look at the market's PE as a guide to look at your overall analysis as well. So right now, the S&P 500's PE is like 24. Mm-hmm. So that could also give you some guidance as well. But I wasn't sure if you hit that. But
yeah, I started with that, and then Corey was talking about industry specific. But I want to make sure that you start. You can look at the overall, but then you have to again, that's why I said you can't look at these things in a vacuum. But it's important for us to take each piece of the fundamental and technical analysis and dig a little bit deeper with them, because again, there's no one formula, but you can get a lot of information by looking at this one number, right? So, for instance, if I'm looking at, we want to stick with the information we have in front of us. If I'm just looking at that sector, and I'm looking at, okay, AMD, between 110 and 113 with a PE, depending upon whose data you're looking at in here. I'm looking at NVIDIA, right? They're in the 50s. And I'm looking at Intel at negative 5.26. I'm like, all right, something's going on. You see what I'm saying? If they're supposed to be competing with them, Taiwan's at 32. There's a huge difference. So we go from negative 5.26 all the way to 112.95. That is a crazy variance there. And in looking at that variance, I want to dig deeper and figure out what's going on with these companies to kind of put it in that position. Is it management, right? Is somebody completely investing into the future and they have something coming up that I don't know about? What's going on there? It's kind of the questions that I need answered.
Correct.
So anyway, looking at the PE ratio as a risk indicator, right? So high confidence often leads to a higher PE ratio. So looking at AMD, people have confidence in AMD in terms of people are willing to pay a premium for the future AMD earnings. So they see AMD as having a better future potential than Intel right now. And again, none of this is investment advice. I do not own stock in Intel or AMD. I'm lying. I do own a little bit of AMD, but as part of my investment group, not me personally.
That's wild.
No, not me personally. My investment company, my investment group. That and by the way, for those who don't know, I'm a part of a all black investment group here in Philadelphia. Hit me up if you're interested in that. But yeah, we do own some AMD, but I personally don't. But I'm just saying what the market is saying based on PE. So the lower PE may indicate a higher perceived risk, right? It's a bigger risk, so you may see a lower PE ratio. People are not willing to pay a premium for that company because of whatever risk they deem that company to have. But you also could find hidden opportunities. And that's why you have to do the knowledge, right? Is this low PE telling me that this company is just being undervalued, or is the PE telling me that there's a problem with this company? So again, I'm going to repeat this because I know people will watch this and say, I'm just going to look at the PE and make a decision. No. Understand what information is giving you and then go do the knowledge. You know what I'm saying? So warning signs. Extremely low PE might be a red flag that there's some serious issues with that company. If a company once had a PE ratio, in the 50s, 40s, and now they're negative Intel, there might be some issues going on. Like, why did your PE fall so drastically? You know what I'm saying? So let's move forward so we can get to some questions and some further talk. Different industries have varying PE standards, what Corey mentioned earlier. Tech companies often have higher PEs than utilities due to growth expectations, right? Utility companies, Exelon is a utilities company. If you look at Exelon's PE ratio, their PE ratio will not be the same as Google's. It just won't. But I was looking recently at PE ratios within the tech sector, and I noticed that Google was looking like a better buy than some of its competitors. But I digress. Not investment advice. Market conditions. Overall market trends can influence PE ratios across sectors. Bull markets tend to drive PE ratios higher. So during a bull market, and we've been in a bull market for a while, you'll start to see PEs become higher because people are allocating resources to the stock market and they're willing to pay a premium for the future earnings of those companies. And like I said in the beginning, and I'll continuously say every class, you're buying equity in a company. I mentioned this already, but startups may have high PE ratios due to future potential, while mature companies often have lower, more stable numbers, right? So if I'm looking at a company that's just coming to market and I'm looking at their PE ratio, it may be extremely high. But if I look at that company and see what their potential is, possibly can have a high PE ratio. So I don't say that you can't make a decision strictly based off a PE ratio, right? I was looking at something that Warren Buffett said, and he was talking about part of his analysis in the beginning when he studied, from his mentor, was looking at the price to earnings metric, which the PE ratio. But when he figured out that he had to look further into a company, it helped him make some of his best acquisitions. When he bought Geico wasn't making any money, but he knew what the potential was, right? So understanding that potential in insurance, he was willing to buy something with a questionable PE ratio that turned out now the PE ratio is all part of the Berkshire system. But if you look at their price to earnings now within that specific part of that company, it's a whole different ball game. You can get information from PE ratio, but you do not make any single decision based on PE ratio. So some takeaways from this morning is this. PE ratio provides a quick snapshot of a company's relative value, helping identify potential investment opportunities. It can be used as a growth indicator, right? It reflects the market expectations for future earnings growth, and it can guide you on potential stock performance. It can be used as a comparative tool, measuring comparisons across companies, industries, and historical performance. And if you take a holistic approach, right? So while PE should be a part of a comprehensive analysis, including other financial metrics and market factors, said it a gazillion times already this morning, do not use it in a vacuum. Do not use it by itself. Use it as part of your overall analysis. Understand what information you can get from the PE ratio, but don't make a decision strictly based on the PE ratio. We took a look at AMD, Intel, NVIDIA, or NVIDIA, depending on how you pronounce it. I've seen people say NVIDIA, but it is what it is. You get the point. Corey and Kamar, is there anything you'd like to add to the conversation before we end the PowerPoint presentation?
Jim, I would like for you to do an example run through of Target and Walmart, Target's PE is 20,
Mm-hmm.
Walmart's 15. They're basically each other's, competitors.
They the ops.
Yep, they're the ops. And I think this is a good one, right? Because one, it's a very popular, known rivalry. But I think you could dig into this and say, oh, this is why this is why that.
So here's what I'll say. What we can do, we're going to take that behind the wall. We're going to take that to the village. For those in the village, we're going to make that a whole class. We're going to do a Target versus Walmart comparison, because what I want to do is take some time with that. I don't want to just like pull it up now, pause and just like go through it, because I want to actually pull the 10Ks. I want to, do a little bit of information.
Well, that's fine. Do this, Jim. Just take 5 minutes and just run through it real quick.
All right. So here's one thing I'll tell you. I was in Sam's Club yesterday. And for those who don't know, Sam's Club is a part of the Wally's World conglomerate. And I'm gonna tell you what took me out, right? So I go there, I always end up at Sam's Club hungry. So I'm going around looking to see what samples they got on the floor, right? Shout out to a brother, man. A brother had his own juice company, and he got a spot in the Sam's Club, and he was doing numbers. You know what I'm saying? I'm fine. So much so that I bought something. I don't even drink juice like that, but I bought something to support the brother. As a matter of fact, I'll get the name of his company. We're gonna talk
what's
about
the name?
We're gonna talk about it on Friday, because I got it's always on the first floor. But I digress. So, but here's what I'll say though. What shocked me is Walmart is considered kind of like an older retail company, but the tech they use in Sam's Club always like amazes me. And I know they test a lot of things with Sam's Club first before they actually goes to Walmart. But first off, they had robots going down the aisles checking inventory and stocking shelves. I'm talking about like it was literal robots. They're on wheels, but they're riding down scanning inventory. Right? They had robots going down each floor, cleaning the floors. And I'm sitting there watching this, and it's like beeping at me, and I'm looking for the person. I'm like, yo, this is a robot. Like, so they're heavily invested in the technology in their company or what have you. So that's something personal from real life. I know you're asking about the specific numbers, but so in terms of looking at these specific companies, what I want to look for is their earnings per share, right? How much are they earning per share, right? The price of said stock. What are the future expectations of that company? What is Target doing to build it for the future? I just gave you an example of what I've seen with my own eyes in Walmart. They're investing in technology. What is Target doing in technology? What other sectors do they have? I go to Target as well, and Target is now, if you look on their app and look at what
now, do you call it Target or Target?
I call it TGT. Although that could be Tyrese Genuine and Tank, but that's another story. But what I'm looking at is what are they building in the future? What are the prospects of them? I noticed Target, and I did do some research on Target. Because again, if you remember, I made a Target options play a couple weeks ago.
So Corey, give Corey his props.
Yeah, Corey did too. Corey called it a week before I did. I didn't even know Corey had called it when I called it. But the thing is, what I noticed about going through, I listened to one of their earnings call and I read some of their information. Target was focused on putting a lot of stores in central business districts down where a lot of jobs are. Yeah, you may not get a lot of parking, right? But what you'll have is people who work towards, like, say, a city center. In Philadelphia, the central business district, the main central business district, I'll say, is around City Hall, JFK out there. That's where all the jobs are. That's where all the people are. There's Targets out there now. There's no parking. And what they're looking at is people getting off work, running in, making purchases before they go home, getting fresher foods and just things on the go. And they're doing those in a lot of cities. So that's something that they're looking at. So I would go as far as literally reading about what their future prospects are, what they believe that growth potential will be, see how they're playing that out in the real world. But also just looking at the numbers. What is Target's revenue versus Walmart's revenue? I don't have the numbers in front of me. How much money are they making? How many stores do they have? How many stores are being built out? Where are the stores being built, right?
What's the track record of management?
That as well. That is absolutely true. Management is like a key factor when you're evaluating companies from a fundamental standpoint. Also, from a technical standpoint, what does the price action look like? How is the market valuing these companies on a month basis, on a week basis, even on an annual basis? So those are all factors I would look at. That's why I said I want to take some time to really do a deeper dive behind the wall.
No, I just want to give him a little meat. That's all.
Hey, yo!
I'm not doing this with you, man. I'm not doing this with you, man.
I'm sorry, y'all. He be violating though. Like,
good googly movies.
Yeah, good googly movies.
Yo, I wasn't gonna say nothing, but
I couldn't help it. Or you went too far, bro. Pause. Like,
hey, yo.
All right, so here we got some questions. I want to pull this question up specifically from Lorraine, right? Do you use the PE ratio as a barometer for your options play? That is an excellent question. And I do, right? So I don't use it as any one thing, but if I'm looking at a play, and I kind of gave a breakdown a couple weeks ago of how I look at sectors, then I'll go within said sector and see, and Jamil brought up the X's. I look at the X's, each sector with the X's. And what I'll do is I'll see what the top companies are within that sector, and I'll compare the PE to each of those companies. So I will do it that way when I'm just looking within a sector to find a specific play. It's not a be-all, end-all at all. And it's just part of a bigger analysis, but I compare apples to apples. So I'm looking in the sector, and I see an AMD, and I see an NVIDIA. I'm like, okay, which one of these do I want to play? If I believe both of them are going the same way.
I also use the PE ratio when I'm looking for plays, because sometimes I just want to look at companies that make money, right? So I want to put in a specific PE ratio. I'll say, especially when I'm looking on FinViz, I'll say PE ratio positive. Like, I just want to know that company makes money. Like, that's then. So when I'm making my options play, those companies are more likely to bounce back, especially like if I'm looking at the like me and Jim say, we go into the depths and we look for companies that are good companies that are falling on hard times, and then we look for companies that will bounce back. If they have a good PE ratio, if they have a positive PE ratio, that means they make money. So that means they're more likely to bounce back. So when I do my dive into companies that are well below their 20-day average, well below their 50-day average, well below their 100-day average, but they make a lot of money, I feel strongly that those companies will bounce back, and those are good plays to get into, simply because they'll bounce back.
Excellent point, Corey. Excellent point. And Jamil says that Walmart's the biggest logistics company in the world. Yeah, that's definitely Amazon on their top though. But yeah.
Well, them and UPS, because UPS is a logistics company too.
UPS stinks though.
This is a good question right here. The second part of the question is, is an excellent question. How often should you check PE if you already own the stock? That's an excellent question, and I guess that depends upon you as the analyst. Like, I don't think it's something that you check every day, but if from quarter to quarter, as they're reporting, their earnings and what's going on, I would say at least every quarter to see what's going on with your company. In my opinion, I don't know whether Corey or Kamari have a different perspective. At least
I would probably more yearly than quarterly.
Okay,
because quarter to quarter is kind of.
I think quarter to quarter is kind of damaging to the overall market.
Yeah, I would more check it more yearly than quarter.
But here's what I'll say from quarter to quarter. If I come in one quarter and you talking about like, we gonna sell dogs, and then I go to the next quarter, you're like, no, we off dogs, we doing cats now.
I'm like, hold on. I'm gonna be a little bit upset with that.
Yeah, so it's like, and again, I also recognize that I'm Paul's a little anal when it comes to this, but that's why I only own a handful of companies, because I don't have time to be doing the deep dive with each company that I own. I own less than 5 individual stocks. Like I just do, because I look at me as I look at it as me owning a company. Even if I own like 100, 1,000 shares, I look at it as like my company. And that's the difference into how I look at it versus other folks. Like, yo, these are my companies, man. So if you owned a store, how often would you check your inventory if you owned a store or you owned the corner store, right? How often would you check your books? So that's how I be treating these public companies like that. Like, because I really have bought into the fact that you're buying ownership of a company, and it's done me well being this way, having a smaller basket, but being very knowledgeable about said basket. So that's my answer. I would do quarterly. Corey's answer is not wrong either. Annually, if you just want to do it that, but you really got to figure out what's going on with your company.
I mean, you should know what's going on with your companies, right? I mean, that should be part of your standard checklist. Just like when you got a car, you got oil in the engine. Know what the PE is, know what the dividend ratio is. You should know all that.
I like that analogy. I'm stealing that, Kamara. Good looking. Pause. All right, so
not doing pause for that, man.
All right, so CT guy says Target is doing that here in Denver, right? So look, and the crazy part about it is, they were talking about this on their calls and stuff before they started implementing it. So CT is kind of confirming what I said, that smaller 3-level stores in areas near business districts, and they are always busy. So it seems to be working for them. But that was a strategy that they talked about. They led into that strategy in terms of looking for spaces and things that they could do that. What about Home Depot versus Lowe's? One is 20.66 and the other one is 27.50. They're relatively close, but that's also showing that people are willing to pay more for the earnings of Home Depot than Lowe's.
They're a bigger brand too.
Yeah, absolutely. I've seen people actually go in Lowe's like, yeah, I'm going to Home Depot. I'm like, dude, it's blue and orange. You can't tell the difference. Like Home
Depot has, how can I put it? They have more granular type stuff. You might be looking for a particular screw. Lowe's might not have it. In my experience, Home Depot will.
So in my experience, it used to be that way, but it's no longer. In my experience now, it's almost like I'm walking in the same damn store. Like literally, like Lowe's is kind of caught up in it from that standpoint, and they're very similar in my opinion. It's like
no, they're very similar, but I'm just talking about like the little.
No, I get what you're saying. I get what you're saying. And I think what you're saying used to be true. You'll see now. Okay. I mean, now Kumar is a landlord magnet. Now you know what I'm saying. Now he's you about to learn, beloved.
You kind of shady too, bro. That was shady.
You about to learn. No, listen. That
was very shady, but it's cool.
It's no shade in that, man. There's no shade in that. Well, that's a Black Wolf story right there. What we talking about? Like that's.
Well, we're gonna talk about it. We're gonna get to it. Yeah, but it was shady. It was shady.
Anyway, and by the way, man, Jamil is telling you that it's not just about Paul, man. It's a cultural correction. Man.
It is not. It is not, and I refuse. To. Listen, I'm older than all y'all. I'm too old for this shit. I'm like Danny Glover.
All right, so Jamil says all of this and more is also covered in the stock valuation analysis class that's in the village. Listen, man, you already know. Join the village, man. That's all I'm saying, man. Lorraine says that TGT has that model in Charlotte built 12 years ago. So the TGT been building out in Charlotte as well. So
yep.
That's kind of their thing, man. Kamari, Lowe's seems to be lacking in the granular items, different product line too. HT had the more known product lines. Yeah. Again, I don't disagree with it, but I think that Lowe's is caught up. Like literally, I was in Lowe's yesterday. Like,
and listen, shout out to Lowe's. They got a black CEO.
Yeah, I support Lowe's, man. And now I got a different reason because I forgot about that. But now that's I'm gonna use that reason. But my real reason is they can be a higher line of credit. But I digress. Is the plan to include housing as future mixed-use property, warehouse with apartment expected to improve Costco's PE? Ooh, great question. And I'm being completely honest with you, Lorraine. I don't know.
I didn't even know that.
I didn't know. I knew that, but I don't know the answer. I didn't do a deep dive, but I have heard that. Right. So that's an excellent question. Maybe we could do some research into that. Let's do some research as a team, as a village. We can do some research into that. What is Costco's PE ratio, by the way? If we're gonna look at Walmart and Target, what's Costco's PE ratio?
But I would say they're different, but yes, I mean it's part of the conversation.
So who would you compare Costco's to? If you look at them on any metric, they're going to give you Walmart as their Walmart.
They are because they're going to give you Walmart, Lowe's, and all of those. That's their.
I mean BJ's Warehouse, but Samsung. But Sam's Club is bigger than BJ's. It's funny though because someone told me
no pause for that. No pause.
You didn't give me a chance to finish, but
anyway, Costco's is 53.7.
All right, so Costco's right. So Costco's is actually higher than Walmart and Target, right? Now, someone told me this, and I never look at those companies the same. They were like, BJ's is like a low class. Walmart is middle class, and Sam's Club specifically, and Costco is bougie. Like it's like different levels of the same thing. Like BJ's is where the undesirables hang at. You know what I mean? Working class folks go to Sam's Club, and then you got the bougie folks that go to Costco. And I thought it was funny, but now every time I look at those companies, that's how I actually see them in my head.
But Costco gives a better product too, so I get it.
Listen, people swear by Costco. It's almost has like the cult like Apple type code. Not quite like Apple because Apple code is a little bit different, but there's a Costco.
Thank you. I'm sorry.
Oh, see this chord now. All of a sudden, he want to laugh. Now it's all giggles, right?
No, because I was gonna say, Jimmy, you didn't say pause at the BJ's. What happened?
You see how Kamari is shady, y'all. You know what I'm saying? Like He's the Aubrey Graham of YouTube. Anyway,
that's low. That's a low blow. That's a low blow.
It's not. Whoa, hey, yo, I give you no low blows on that one. All right,
see, you had to pause yourself because that was an hey yo moment. Hey yo,
I'm only doing it for y'all.
Let me conclude today's PowerPoint with this. And it's just going to be me reiterating what I've already said several times during this presentation. Is look at the PE ratio, but make sure don't look at it in a vacuum. Don't just use this as your one metric. We're going to talk about other metric as we go along this series and be able to figure out what metrics work for you. Now, do you have to look at every metric? I would say no, but you may have a handful of metrics that you specifically use. The whole idea that we're trying to get through with this education part is you have to figure out your own system. I have a system. My system differs from Corey, whose system may differ from Kamari. But the one thing I know is that Corey does his homework. Even if I don't use the same system, I know that Corey won't just throw something out there, right? And shout out to our sister, Dr. Chaz, who always says, like, you know what I mean? I'm not wrong, I'm early, right? So when you learn to do the knowledge and do the research, you can be right. Doesn't mean that you always will get it right in terms of a trade or an investment, but you want to make informed decisions. That's what we're talking about. We're talking about making informed decisions. Don't be one of these people that, like, you know, you walk out and you see like, oh man, I bought this. This is my favorite company. I go to Rite Aid all the time. I buy some Rite Aid stock. Don't be that person. Don't be that person. What does Rite Aid numbers look like, right? Just because you go to McDonald's every Tuesday doesn't mean that McDonald's has great numbers. And again, I'm not saying they do or don't. I'm just saying learn to use some of these tools to do a deeper dive. So, and we're going to talk about what we're going to look at this upcoming week in the market, what we're watching. We'll jump into that. But thank you guys for sitting through this PowerPoint presentation about PE ratio. For those that are in the village, you get a chance to watch just the PowerPoint by itself because we're going to, you know, chop it up how we do. But thank you guys, and I will move on. So how does the PE fair versus EPS, are they separate or run concurrent in analysis? So the EPS is a part of the PE analysis. It's PPS and EPS are the different variables you use to come up with the PE ratio. So CT says, gotta go, team. Appreciate the knowledge. Enjoy the rest of your weekend. First full week of the new year. Back to work. Take care. Have a great week at work. Thanks for pulling up,
Have
CT.
a great week, man.
Yeah, we'll see you on our next live. You know what I'm saying? Like, you know, we coming back Wednesday and Friday, pause this week. You know, he said, by the way, I just noticed you're on By the Hood podcast. Like, no, listen, for the CT, I know CT's new to the thing. So By the Hood is actually one of our brands, right? So By the Hood, so the Black Wealth Rebels, right, are a combination of By the Hood and the Finance Rebel. Kamari had his company and brand, the Finance Rebel. Corey and I had our company and brand, By the Hood. We decided to merge and create a new entity called the Black Wealth Rebels because one of the things that we talk about with culture is partnering, right? Partnering is important. So By the Hood is ours. And when I say ours, I mean me, Corey, and Kamari, because Kamari is By the Hood. Me and Corey are the Finance Rebels. So collectively, we are the Black Wealth Rebels. But you will see stuff on By the Hood's page on, you know, Instagram, YouTube. You'll see it on the Finance Rebels page, Instagram and YouTube. But, you know, it's 3 different streams because we want to make sure we get the information in front of as many folks as possible. And those are our entities anyway. We own all that. We own the Finance Rebel, we own By the Hood, and we own Black Wealth Rebels. That's all us. But no, I appreciate you looking out though. CT looking out for us, like, yo, he want to make sure we love. So it's love anyway, man. Appreciate you, man. Have a great week, CT. Appreciate that. And K Diggy is right, man. Go like all 3 streams, y'all. You know what I'm saying? Let's get these numbers up. Hit the like, hit the love button. We're going to talk about, we're looking at this upcoming week in the market. I've been talking for a minute, so I'm gonna give the floor to my brother Corey, man. Corey, what are you looking at in the market this week? And by the way, we don't talk about what we're looking at in the market before we jump on here. And I was thinking about that because I was going to tell Corey what I was looking at to make sure we don't have the same play. But I don't think we do, though. We'll see.
Man. Nah. Do the knowledge.
Because I know sometimes we both be in the depths of hell looking for stuff that's fell off a cliff.
Yes, we do.
Yeah, so, you know.
But, all right, let me share my screen. I'm trying to share my screen. Let we go. Share present. Share screen. What is going on? Why is this taking so long?
I don't know. That's what she said.
I mean, I hope that's what she said. It could be the other way.
Y'all want to be one way, make it the other way.
It could definitely be the other way. All right. So what I'm looking at this week is ExxonMobil. I'm looking at the volume coming into ExxonMobil. We at 107.86 now. And I'm looking at entering ExxonMobil on a candle that goes. I need to spray this out. Excuse me. I'm sorry. Eyesight is terrible.
It's funny because they're what's their XL whatever it was. It popped up on my screen last week because they've been beat up. Like the energy sector has been beat up overall.
Yeah. So anything past 10, I'm looking at anything past 108.49.
Mm-hmm.
108.49 is my trigger to entry on a call, and on a low, I'm looking at entering a put anything under 105.51. So, but I'm more likely, like I said, a call past 108.49 and a put at 105.51. So if it stays in this range, I won't do anything. But if it goes past 108, if it goes past 108, 108, what was that? I'm sorry, 108.49. If it goes past 108.49, I'll be hopping into the upside. And if it goes down past 105.50, then I'll be hopping into the downside. So I'll be watching ExxonMobil this week. That's what I'll be doing.
Okay. All right. Shout out to Exxon. You know what I'm saying? Shout out to CT again because I mean I'm reading about oil right now. So now I'm all interested in your play because man, I'm studying the oil sector. But with that being said, I like this play too because this is what we look for. We look for things that kind of a little beat up, but are companies that we know aren't going anywhere, that are strong companies. Exxon is going nowhere, by the way, guys.
Absolutely nowhere.
And they're beat up a little bit. If you look how it fell off a cliff, look at all those red candles. So ExxonMobil, that's an excellent play, Core. And you said your range on the upside is you wanted to hit what, and the downside is what?
108.50, and on the downside 105.50.
Okay, so that's the range. All right.
Yeah,
let me get on play too. I like that because the thing is, we don't care whether it goes up or down. Pause. We want to make money, so we have a range. If it hits this number, we're riding to the downside. Pause it again. Hits this number going up, we want to make money that way. Look at Danny Glover shaking his head over there, man. But
I ain't got time for this shit.
So I got a couple things I'm looking at this week. And let me share both of them because I got one as a long-term buy and hold play that I'm looking at, and I got another one that I want to trade this week. So let me share my screen. Let me share my screen. All right, so I'll give y'all the buy and hold play that I'm looking at this week. I'm accumulating as many shares as humanly possible. Being transparent, I already own a lot of shares of this specific ETF, and I've brought up this ETF several times, and that is Top T. Right now it's trading below $30, which to me is I'm a dollar cost average in the Top T. I'm gonna buy as many of these as humanly possible. This is one of my biggest holdings now. I went from just being released months ago to I've been going crazy with Top T. And for those who don't know what Top T is Top T is the top 20 companies within the S&P 500. So instead of having to buy every company within the S&P 500 when I buy that basket, I'm getting the top 20 companies. I'm getting the Apples. I'm getting Google. I'm getting Facebook. I'm getting NVIDIA. I'm getting Berkshire Hathaway, right? That's 5 of the 20 right there. I'm getting Google. There's 6, right? I'm getting Exxon. That's 7. I would say here name all 20, but that's not the point. The point is the top 20 companies in the S&P 500 by market cap. I get exposure to all 20 of them. So, although I say I'm not like that diversified, I am diversified because I have top T. So I have 20 of the biggest and best and brightest companies in the world, all working for my benefit. So guys, go out there and continue to work. Appreciate
it. It's like the better Dow 30.
To me, it is a better barometer than the Dow, right? So these are the companies that carry the market. Over 70% of the returns of the entire S&P are from these companies anyway.
From the top 20 companies.
Yes. So there you go. Now I know some people like to have the full basket, because things move. But what I also like about ETFs such as this is they're self-cleansing. If one of you guys aren't performing well and you start stinking it up, you will be kicked out and someone will be brought in your place. You know what I'm saying?
Real quick.
It's how Goldie used to talk to his women. Like, y'all gotta get if you ain't want to get out there and go to work for me, you're going to be replaced. And so I call this my Goldie stock. I'm sorry, go ahead, Kamari.
No, I didn't have that.
And I like
you don't like my analogy, man?
No, it's fine. Listen, The Mac is one of my favorite movies. For those who missed that reference.
Okay.
So what Lorraine did is she put the PE ratio in there for top 10.
Mm-hmm. Yep.
Thanks,
and again,
Lorraine.
this is a long-term buy and hold for me. This isn't something that I'm trading, by the way. I'm buying this to hold for the rest of my natural life.
Yeah, I think I might switch over my what's the names too. Switch over my shares in SPY, not SPY. I had the Vanguard version.
VOO.
Mm-hmm. Switch it over to top T because I really didn't want to have control of 500 companies, and now I have an option.
So this is what I'm looking at this week for a long-term buy and hold. And by the way, for those who don't know, and I've shared this before, when I be rumbling SPY every day, me and SPY go to war every day, and I make profits on them. Like some days you may see me not put a trade, it's because I don't like the way it's ranging. But most days you'll see me put a trade about SPY. If I make $300 that day, $1,000 that day, $200, $150, whatever it is, I'm doing that with the intention of buying a long-term buy and hold, right? So again, being very transparent, my day trading SPY, I do within Charles Schwab. I have a whole separate account just for SPY day trade. I literally have one account that I use for day trading SPY. But because I use it at Charles Schwab, which is connected to my regular Charles Schwab brokerage, if I make $200, I could press a button and send it to my long-term hold. So I have a little bit of money allocated to just beating up SPY, and whatever I make from that goes to buying top T. You know what I'm saying? So even my trading is done with the intention of buying something longer. So I'll put that out there because we don't trade for the sake of trading. We're trying to build long-term wealth here. Now, my short-term swing play, and by the way, my swings, I got in a whole other separate account. You're like, Jimmy, you all over the place. Well, I'm taught to be decentralized, by the way. So my swing trading is not even with Charles Schwab. My swing trading is in a SoFi brokerage where I do swings. If I'm going to make a trade that's a month or more out, whether that's a leap or a swing, that's done in a whole separate brokerage account. And let me share my screen and show you what I'm looking at from a trade standpoint. This is what I'm looking at. Looking at Starbucks. Let me pull it up on the daily chart. You know what I'm saying? I'm trying to get, to my moving average right here, which is the white line. You know what I mean? Starbucks fell a little bit if you look over the last several days. You know what I mean? So we're looking at Starbucks right now. And if I go to the undesirable chart, and by the way, when I'm trading SPY on a daily basis, this is where I'm at. I'm on here with the undesirables. And as a side note, right, although I do set up things for swings, like, month, 2, 3 months out, I have a specific number in mind. If I hit my number and it just happens to be, 4 days out, I will take my money, even if I have months left on the contract. I want to put that out there too from a strategy standpoint. That's me again. Y'all know I got my number. When I get my number, I'm Forrest Gump. I want to get my money. I want to get my reparations out of the market and keep it moving. So I'm looking at Starbucks. I'm looking at the $90 calls for February. February 21st, I believe, is the monthlies in February. And I'm looking at Starbucks. I'll give you my range as well for a Starbucks play. I like the way Corey did that, Paul. So I'm going to give you my numbers for Starbucks. Let me look at this for a second. So again, my call is a $90 call, right? February 21st. And on the, let's see, on the downside, what I want to do on the downside, if we fall below, because right now we're trading at approximately 92.58. So I would say that if we fall below, if we hit somewhere in the 80s, like 89, I'm then moving it. I'm changing that to the downside. As a matter of fact, I would even go as far as to say, making $90, my $90 my strike price on the upside for February 21st. But if we fall below 90, I might start looking at going to the downside. You know what I mean? So those are the levels that I'm looking at. So right now we're at 92. We're at 92.81. That's where we're at. I'm sorry. 92.58. I'm sorry. 92.58. I got all these charts moving. It closed at 92.58. Right now we're at 92.54. So it fell a little bit, which is cool. After hours, it fell a little bit. Because again, I like to also enter trades to the upside if I'm getting no call option. I like to enter those trades on a red candle. And that's difficult for a lot of people to do. But this is why you have to do the knowledge. If you do the analysis and you really believe in what you're saying, would you rather enter a trade like, going the way that you want it to go? You're going to pay more for it. If it's
it's counterintuitive for your average person.
Absolutely it is. Absolutely it is. Like, and no one wants to catch a falling knife, right? So you're afraid that I'm going to buy it while it's going down. It's going to continue to go down. But if you've done your analysis and you believe in what you say, specifically because I'm buying this out for, to February 21st. So I'm looking for this red candle. So even if it open reds, I'm going to just watch it. As long as it doesn't fall below a certain level, I'm going to take the trade to the upside and, watch it. But I'm looking at Starbucks. Again, I don't think Starbucks is a company that's going anywhere. Now, the one thing I do want to caution people from doing is just jumping in trades. Me and Corey talk about what we're looking at in the market, and none of this is investment advice. It's for informational, educational purposes only. And we're sharing our analysis and what we're doing. I put that out there because I know some people say, well, he said Starbucks and he said Exxon, and you just jump in the trade where you got to really, really be careful about your entry because you could be right about the analysis, but if your entry is wrong, you can still lose money. So Cedric says, I believe the Starbucks strike is still going on. That's possibly true. Now, here's the question, though, because generally speaking, I would take a Starbucks play all the way out to 2027. I'm trying to do a shorter swing right now. How long do we think the strike will last? We know it's not going to last forever, right? It's not going to last forever. But the question is, when they settle, how will that affect the company? Will it be a red candle or a green candle? Because believe it or not, sometimes, I know it's sad to say, but I've woken up sometimes and I see a company announce a bunch of layoffs and firing of people, and the stock goes through the roof. And I've seen people get upset about that. Like
prices go up.
It's like, how can you fire all these folks and do all this? So on the flip side, if you give people more benefits or better structure, sometimes that can make the stock go down. That's why I want to give levels on both sides, right? Sometimes if this price goes the other way, I'm going to play it to the downside and I'm going to make money on the put. I am not emotionally invested in Starbucks or any of these companies, or most of these companies, or all these companies, except for one. There's one company that I'm irrationally long in, but we'll talk about that behind the wall.
So real quick, Jim, I want to give a shout out to F.E. Coleman. They just pledged to the village. Shout out to you. Welcome to the village.
Salute. Shout out to all new village members. For those that aren't a member of the village, go to blackwealthrebels.com and join our village. Again, more content goes to the village. I have a Bitcoin weekly show, Stack Sat to Die Trying. The village gets that early in the week before it hits all the regular channels. So you get access to things early and you get access to things that just won't show up on YouTube or Facebook. So, and by the way, when we actually are investing in trading, we're sharing that in the group. As an aside, I shared the Leap trade this week. If any of you guys took the Leap trade, you should be up already. First of all, even if you bought just one, I was wilding, so I bought a bunch. But if you bought one, you should be able to at least $200 to $250 already just on that one contract. And that was shared in the group. And I'm pausing for dramatic effect. So let's keep it moving.
Which one was that again? That's what I'm looking at. Huh? Which one was that again, Jim? I missed that.
The one that I'll put it out there now because you guys, if y'all
what was it?
It was C3 AI.
I think I missed that. Okay, good stuff.
It's in the village. I told you guys when I was entering. I told you guys when I bought it, and I gave you my analysis on why. It's a lot of reasons why. Like you talk about doing a deep dive in the company. I've actually met and sat and talked down with people that work in the company and like basically grilled them. But that's neither here nor there. When you get a chance, go look at their board members. That's something else I do too. I want to see who's on your board. I want to see how tied in your board is. Right? We talk often about how politics and the economy factor in. One of the things I notice about companies that have a lot of success long term and who are building things, I look at their board, and their board always got some sort of government tie-in. But that's
of course,
whole other tie-in, man. Whole other tie-in. For all you Tesla lovers and Elon lovers, yeah. Go listen, man. They call them government sacks. Some places I go, they say government sacks. They didn't call them Goldman Sachs. They call them government sacks. But look how Elon makes all his money. People think Elon's out here creating all these great things. Elon be getting government contracts, though.
Well, I mean, so somebody made a mention, I think it was CT Guy, talking about Intel's relying on government subsidies for buildings. If you really do the knowledge, there's a lot of big companies that get government subsidies. Do you think the reason why everybody's buying Teslas is because everybody loves them? No, there was a government subsidy called a tax credit that a lot of people got when they was buying these Teslas early on. So
yes, it was. But the problem with Intel is, at least they don't seem to be. When I watch a lot of I'm a tech
that wasn't. I'm not.
No, I get what you're saying. Yeah. I'm just adding more color to what you're saying, right? So I'm a tech snob. So anytime that I'm sitting here now with an S24, iPhone 16 Pro Max, and I got a Samsung tablet. It's all sitting around me as I'm like talking to you guys with my notes. I'm a tech snob, so I often watch a lot of the tech videos of introduction of products and chips and things like that. I've even watched AMD's calls sometimes, and they just don't seem to be innovating as much as the other companies do. So some would say that's a management problem, not necessarily a contract problem. I don't know what it is. I haven't done a deep dive in the company specifically, but when I look at what's being put into the market from them versus everybody else, it just doesn't seem to be going the same way.
But Jimmy, I want to pile on before you give me a pause. The board actually runs the company. People really don't realize that. They say management runs the company, which it does, but the board really makes everything happen. Like people talk about the CEO this, the CEO that. Look at the board. So
I think they do. I think they do a combination. I would add that I think the board is responsible for who the CEO is, right? So a lot of times the CEO is on the board, right? So I think the board overall does. I think the CEO has more of the day-to-day. And I think even beyond that, the COO a lot of times has more of the day-to-day.
Management is day-to-day. The executive suite is day-to-day. The board is strategy and overall placement. So, but
the problem is sometimes those day-to-day decisions can F a company up.
Correct. But I think a lot of people miss that, especially in our culture. Right? They're like, I want to be the CEO. It's like, no.
Because we've done bastardized the term of CEO, right? People get excited with titles. Me and Corey talked about this before. A lot of times in our culture, we love titles so much. I told a story on Friday about two gentlemen, I think it was in Carolina, I believe, who had the tire companies, and their consultant and legal consultant told them, you guys should merge. If you guys merge, you can have one of the biggest tire companies in the entire like eastern side of the country. And they got so caught up in who had what title that they never merged, and both of them went out of business, right? So we get caught up in titles too much. I can go start an LLC tomorrow and put my name as CEO and say, yo, I'm the CEO of this. What does it actually mean, though? What does it actually mean? I've seen people start entities and actually go into a rabbit hole like, should I call myself president? Should I be CEO? It's like, well, does it matter? What are you building? What are you growing? What kind of value are you providing to the marketplace?
I'm the CEO of a $5,000 company.
Listen, and that's a whole other conversation in terms of us wanting to have full control and ownership and not understanding the idea of working as a collective, right? Would you rather be the CEO and 100% owner of something that makes $20,000 a year, or would you rather be like, have no title at all, but have 20% of something that makes $1 billion a year, right?
Whole other ball game.
You know what I'm saying? When Steve Jobs left this planet, I think he only owned like 1% of Apple, but he was a multi-billionaire. He owned 1%, right? But people get so caught up in these percentages and these titles and not looking at the bigger picture, man. I'm trying to show you the large picture, like Low Deluxe says. But it's about the bigger picture, man.
I bring
Shout
that
out to
up.
JT, man.
Right, but I bring that up. I bring that up because it's a wealth thing. It's not a money thing. It's a wealth thing. So,
yes.
ooh.
Listen, man, I would rather be. I'd rather be to be Jimmy by himself out here talking trash online. I've been that too. You know what I'm saying? That's like me and Cool. I'd rather be one half about a hood than I would be by my lonesome. I'd rather be 1/3 of the Black Rebels and all of it, right? The more people we get to build with, the better we are. You know what I'm saying? Because to Corey's point that Corey mentioned in the book that could be only compared to the Bible and the Quran, that wasn't me. Somebody else said that, right? I own your time and space. When you partner, you create time. You literally are you're creating a time machine. You know what I'm saying?
You create synergy.
Yeah.
I know people hate that word now.
Shout out to JT, man. JT, did you get the sats that were sent to you, man? Did you get the sats? Matter of fact, I think you did respond. You got the sats. Did you get the sats that were sent to you this morning, man? Because JT, he won our giveaway on Friday. He was one of 2 winners in our giveaway. And by the way, for those watching now that don't watch Friday, every Friday we do a Bitcoin giveaway. We give away Bitcoin. You know what I mean? So, we gave away 50,000 Satoshis on Friday. He sure did. There we go. Congratulations again, and salute to you for always supporting what we're building over here, man. It's definitely appreciated. You are appreciated, and you are a member of the village. Anyway, that's what we're looking at this week. We're looking at ExxonMobil. We're looking at Starbucks. We talked about the PE ratio. I'm also looking at top T as a long-term buy and hold. So that's what we talking about. Anybody else want to add anything? Kamar, Cole, before we get out of here, man?
No, I don't have anything. Now, this is going to be our last one of this nature where we're giving plays. Everything else is in the village, correct?
Yeah. We're gonna do some. We're gonna come Sunday on the live. Probably teach some classes. But in terms of giving actual plays out, man, because I know people in the village are like, "Yo, I'm in the village. I want to have some exclusivity," and you will get the exclusivity. That can't go into the public anymore, man. Because I told people I've been on fire so much, Kamar, that I told people that my problem now is I want you to know it ain't always gonna be this way. It ain't always gonna be this way. Your boy takes L's, right? Your boy takes. It don't look like it right now, but your boy takes L's. And I share that too. I have no problem sharing my L's. You know what I'm saying? I have no problem sharing my L's. But the village got to get some exclusive stuff because you guys are helping us grow, helping us build, helping us create something that'll be around forever. We're trying to be like the Coke and Pepsi of the future. You know what I'm saying? But for our people. Are Coke and Pepsi considered government recipients, being that $4 billion a year is spent on soft drinks, 10% of all EBT revenue? That's a funny question. Now, here's what I'll tell you about that is, what is $4 billion to Coke and Pepsi when you look at their overall earnings, though? You dig what I'm saying? Like, what kind of earnings does Coke have on a annual basis? Like, Coke and Pepsi are damn near their own governments, man. Like, I was watching it was an interview. The dude was the founder.
Wow. So just real quick.
Go ahead.
Sorry, Jimmy. I didn't realize Coke makes $46 billion a year. I knew it was up there, but damn.
That's the thing. Coke is so large as a company, right? So I tell people the story all the time personally. Coke is the first company I bought stock in, back in like '96. The first company I ever bought stock in. Yes, I'm that old, y'all. But again, I also started when I was younger. I started investing in the stock market as a teenager. But it's the first company I bought stock in. The reason being is because I didn't know what I was doing at the time, and the brand was so recognizable. Everybody drinks Coke. Let me buy Coke. I didn't know nothing about its earnings or anything. I was buying a brand name. But I built up a large position over decades. I recently got out of the position. I shared that with our folks when I got out of the position because I just didn't see any growth there for me. So I say all that to say this. They are damn near their own government, own country. Coke makes a lot of money. And in fact, Coke and Pepsi, like Coke doubles Pepsi. Pepsi is smart in terms of their management because they got into the business of offering snacks and things of that nature. So Pepsi, a lot of people think that may be a better investment. I'm not saying it is or isn't, but Coke focuses on what they do and they do it well. I was listening to an interview with the guy who was the creator of Honest Tea. You guys familiar with that brand? I don't know if that's my computer or y'all computer, but I feel like I was matrix for me. All right, yeah. Are you familiar with the Honest Tea brand?
Yes.
All right, cool. All right, so the owner of that company, like their whole strategy when they came out was there's a debate whether sugar is bad versus using artificial sweeteners and things of that nature. His thing was, I'm going to use sugar, but I'm going to use less of it. A lot of times in these soft drinks, he says that they overdo it with sugar. So I'm going to use sugar, but use a smaller amount, and I'm going to be honest about what's being put in here. Hence the term honest tea. And people resonated with that idea, that brand, and that brand was making money hand over fist. And then what happens? Coke pulls up, right? Coke was like this, yo, we want to buy your brand. And originally he was like, no. And Coke was like, all right, so dig this, right? Either you sell us your brand and we're going to give you fair compensation for it. We're going to make you rich and we're going to give you a bunch of equity in our company. But if you say no to this, we're going to build a competitive brand and we're going to spend billions and billions of dollars to make sure that your brand no longer exists. So in our community where we come from in Philadelphia, we call that get down or lay down, right? You muted, Corey, but yeah, in Philly, we call that get down or lay down. And he tells the story in a beautiful way because now he's a wealthy man, but he had no choice. Basically, that's how Coke grows now. Coke grows by, oh, that's what you're doing? Come through, be a part of the family.
Just like Facebook.
Yeah, it definitely told the boy from honest to get down, lay down. Like that was straight up like gangster music. Like they played my man some gangster music into him. You know what I mean? Like be a part of the family or be a part of the non-existent.
Or join the ancestors.
My man,
join the family or join the ancestors.
But it's funny that actually happens a lot in corporate situations.
Yeah, but I heard him tell that story.
Does,
and,
but
go ahead, Corey.
No, I was saying Jim put me onto a podcast about business wars.
Oh yeah, it's a fire podcast.
Stories, bro. That the absolute chaos that these companies cause to each other and the small businessman. Yo,
speaking of Coke and Pepsi,
crazy,
in that podcast,
like
there's a whole series
of Business Wars.
Yeah, Business Wars has a whole series on Coke and Pepsi. And what I found, the thing I found most interesting about that, outside of Coke being so much bigger than Pepsi, was
no balls.
Pepsi is large in the African American community, and it's a historical reason for it. They talk about it within the podcast. Coke was kicking their ass so bad, they were trying to figure out a way to make some money. And they were like, yo, no one's serving this community. They actually sent folks into the community to sell to our people. And that started something that still exists to this day where
and black folks saved the day. Our
folks love Pepsi, right? But it's historical context behind it. And they actually go into it in the podcast, which I found interesting. Like yeah, it's like we were looked at as an afterthought originally, but it's like, yo, that's an untapped market. We were looked at basically as an untapped market. Anyway,
I mean, because it was. Nobody sells directly to black people until they realize we actually have some money that we like to spend.
That right here is an excellent question. So Cedric says, excellent question. What factors will make a share price rise despite the company going through a strike? I believe they lost $13 billion in revenue so far. So their next earnings.
Can I simplify?
Well, yeah. Let me say one thing. Their next earnings is 30 days out, so we'll see just where they are now. But go ahead, Cole. Go ahead.
I'll tell you this. If they lost $13 billion in revenue, they probably made triple that, quadruple that in for not paying out salaries. On the books, most of the time, most of the company's biggest expense is salaries. So that's why when people get fired, the companies actually make money. So revenue compared to what they saved in salary would probably be the what you want to look at, and they probably made money through this.
Also, I'm not sure. I'm not sure of that specifically, but what I would say is the market also moves on emotions, and I'm just looking at price action. There are a lot of buyers and sellers on different sides of that equation, and they're only going to let it fall so far. So I'm looking at the fact that it's been beat up a little bit and it's falling. They have an earnings coming up. I think within 30 days is their next earnings. And I'm looking at like what they did during the holiday season. I was following the company in terms of different things they offered in the holiday season. And I think they're going to push price up. Again, I'm only looking to make a small bag and go away. This is not a long-term play for me. I'm looking to get a couple dollars and then put it in the top T, as I said. So,
and poof.
Yeah, and I think that I don't think they're going to let price push down, but so far. Now, if they do let price go down that far, I'm looking to play it to the downside. That's why I kind of gave a range of where I'm looking at. But that's an excellent question, Cedric, and thank you for that question. So that's a question right there. And that to me, that's an opinion question, right? Depending upon which investor you're talking to and how they look at their portfolio. I would like to hear what Corey and Kamari say about this. Do you think Coke is larger because of its branding, or is Pepsi a better company because of its diversified portfolio? How would you look at that as an investor?
Well, wait a minute.
Corey, did you hear what he said?
Yo, is that my internet acting like that?
Oh, I think that's Kamari's because it's only on Kamari's side. Kamari, we didn't hear what you said.
I said, how are we defining large? Because I believe Pepsi has a larger market cap, don't they? I'm looking it up right now.
Let's see. I know what's
so
in the
Pepsi
beverage industry.
In beverage,
he was asking the difference.
Right.
So the difference between Coke being larger and Pepsi being a better investment because of its diversified portfolio. I mean, personally, I would just buy the ETF, which is the consumer defensive, and then get both of them.
So Coke is larger. Coke
I just looked it up. So Coke is 205 billion. Pepsi's 205 billion. Coke is 266 billion. So, but you know what? I always thought Pepsi made more revenue overall. Coke is clearly the leader in beverages.
Revenue compared to expenses, though.
But to Jamil's question, though, Coke also has that Coca-Cola brand, because if you look in the beverage industry, right, the top two sodas are Coke and Diet Coke. Pepsi's not even two. Diet Coke is bigger than Pepsi, right?
That's funny.
But Pepsi, but this also goes to the conversation we were having about like the board and management. Pepsi made a decision years ago. We're going to diversify. We're going to compete with you in soft drinks, but we're going to add Fritos. We have all the things, right? So I guess the overall question is, would you rather have a company with that diversified portfolio of products, or someone that's just like solely focused on one thing and dominating that one thing?
Coca-Cola is such a big company that its bottling company is on the actual stock market.
That's true too. They split that out.
Coca-Cola is so big that the bottling company.
What's the market cap of the
point? Right. So if you add up Coke, KO, and I forget the bottling company, you add them together, that's crazy.
It's COKE. I believe it. I believe it's COKE. That's like another 12 billion, I believe. Anyway, but I guess, but I think it's without using those two companies, I think it's an excellent question overall, though. Let me see. So I'm going through some of the questions. Don is in the building.
What up, Don?
All right, so shout to Lawrence too. Lawrence said that Coke is global, which is true. When I travel, I don't even see Pepsi the way I see Coke. Coke is everywhere. Everywhere. You know what I'm saying? But that's an excellent point about it being as global as it is. But Don says he likes the snack brand. He likes to have the snack brand as part of the overall company. Pepsi snack brand makes it a better buy for him. So I still didn't get you guys' answer. Which one would you rather have? If I dropped $1 million on your lap right now and said you got to invest in one of these two companies, which one are you taking?
I'm taking the old head. I'm taking Coke.
How about you, Kamari?
Well, I'll take Pepsi.
Because they got a longer proven record.
All right, so now we're going to have this debate behind the wall. Corey and Kamari go at it while one takes Pepsi and one takes Coke. We're going to have a debate. We're going to make it like a battle rap. We're going to have 3 rounds. I'm playing smack.
I'm just going to do it. Y'all going to do it. Listen, man. We're
going
to talk about dividend. Huh?
Listen, I just created a whole new show, Corey. We're going to have company battles, right? You and Corey, 3 rounds each. Y'all gonna give me y'all reasons for why you want to buy Coke, you want to buy Pepsi, and I'm saying we're gonna have I'm gonna play smack. I'm gonna stay.
We can do company comparisons.
I ain't saying y'all gotta rap.
Comparisons.
I ain't saying y'all gotta rap.
If you know which one we would, take. I'll do that. I go bar for bar with Kamari like that.
I ain't saying y'all gotta rap, Kamari. I'm saying y'all gotta give y'all thesis, and I want to hear it out, right?
Listen, I'll rap.
Just created a new show.
No, Kamari stands.
We hear that, Corey? Corey actually rap if you want him to.
Listen.
You don't stand no chance, bro. Leave that alone.
Listen.
But
all right, well, hold on though. I need the community. We got a number of folks watching.
Yo, listen, you don't stand no chance, bro. Leave that alone.
We need a title for our new show. We're going to battle stocks. We're going to have Corey on one side and Kamari on the other side.
Stock SmackDown.
That's our new show.
I ain't going to listen.
All right.
Let's have it.
Everybody listening, right?
You don't want to go with that, bro.
Don DeMarco. All right, everybody listening right now. If I dropped $1 million in your lap and you had to invest the entire $1 million in Coke or Pepsi, which company are you taking? I want to hear what the folks got to say before we get out of here. And Cedric said he actually listens to Starbucks call. Look at this Cedric guy here getting to it. They're returning to implementing and they're going to spend heavily in redesigning their lobby. So they're going to invest in the actual lobbies of that, and they're going to implement a condiment bar. That's interesting to see. So Ryan says Pepsi for him. Don says Pepsi for him. So far, Pepsi got the lead. And Jamil
Where did Don say Pepsi?
Don said
I see that.
He gave context. Yeah. He said because of the snacks.
Yep.
All right.
Oh, damn, we got fans. Corey, we got fans. Team Corey.
Team Corey. All right, so Jamil says one of the best things Pepsi did was ditch Tricon Global, which is KFC, Taco Bell, and Pizza Hut. Those brands have fell so far. Like, their quality is so terrible now, so bad.
All right, so Lorraine is biased.
No, she already owns Sharon Cook, right? So, Pepsi has the better chart. Shout out to Dina. Dina's in the building. She likes Pepsi's chart better. Cedric is going Coke. All right, so it's kind of split, though. Now it's kind of split. It's like a little bit of Coke, a little bit of Pepsi. So we need two. All right, so now we talked about this, y'all. Here's the last thing I need before we get out of here. We need two companies who are competitors for the next battle we're going to do behind the wall. Corey and Kamari going to do a stock
Walmart Target.
Walmart
Target. Walmart Target.
All right, so but the question y'all gotta be on opposite sides of this though. So Walmart Target, who's taking what side?
I'm taking Target. They got better coffee.
All right, that's our next battle. Our next battle. Our next
I'll
battle.
Take the old head company.
Our next battle coming soon.
I'll take the old head company.
We got a lot of different
ideas. This is a good one right here. That's a good one.
All right, so listen.
That's not a good one.
We're creating
a comparison. They don't. They're not. That's not good, man.
But it's a good battle. It's a good battle.
I don't think it's a close comparison.
Well, J&J is more diversified.
All right, we're gonna do Walmart Target.
Hold on.
Somebody screenshot that so we can do all of these.
Hold on though, because J&J just spun off all their consumer brands outside of the pharmaceutical joint. They got a whole separate company that's listed on the market.
Yes, they did.
Jamil said Dollar General and Walmart. I don't think Dollar General is Walmart's competitor, dog.
They're not. They are not.
Yeah, they're not on the same strategy.
Walmart's logistics is actually top tier. Really is. Outside of Sam's Club. The way they move freight, the way they move product inventory, it's crazy. And the funny thing is, they actually got a late start. Amazon was eating their lunch.
Yeah.
And I'm giving Corey, gems. So, but I love it.
Hold on. We're going to save it. We're going to save it. We created a new show live on our Sunday show. We need a better name, though. I don't like Stock Smackdown. We need something that's better name. I want the folks to come up with a name for the show. I'm giving y'all what the show is going to be. Y'all got to come up with a better name, though. I've never seen a show like this on YouTube, by the way. We're going to have actual battles, man. And it's going to be 3 rounds.
The stock ball show.
It's stock ball. We're going to have 3 rounds. Somebody going to take one side, somebody going to take the other side. Y'all got to have a battle. And then the people are actually going to vote on who's the winner of the battle. That's our show.
Ooh, I like
Ticker
this.
pickers.
We're going to look at 3. We're going to look at. Hey, listen, right, man. I like that. I kind of like that. That got a little ring to it. I
like where you're going with this, Corey. First round is going to be earnings. Second round will be something, and the third round will be growth potential. We got to figure out what the second round is. Company clash. All right, now we're getting somewhere. Company clash. It's not bad. I might hip hop it out and use a K or something. No, I can't use K. You know, too many Ks make it look kind of crazy. So
no, bro. No, you won't. Not with me. No.
It's gonna look kind of wild. I'm trying, trying to make it hit. But we gotta find a title for the show. But we're gonna bring the show.
No,
Stock Rebels.
No keys, no K's, bro.
All right. So Don says he don't think Walmart has a direct competitor when you think about their shares. Oh, y'all giving Corey bars right now, man. Y'all got to chill with giving Corey the bars, man. So
I'm just saying,
it don't matter.
They do have a direct competitor. They do have a direct competitor for share size. No, they do. They do. That direct competitor is actually Amazon, but
I don't know about that though. I don't know. I think what makes Walmart and see, I don't want to give you too many bars. Walmart is competing with
40% of all products that are bought on the internet. 40% of all products that are bought in the world are bought through Amazon, and so online. And then, so when you talk about share size, Amazon would actually be the competitor for Walmart.
But Walmart is still the largest retailer. So Walmart still is the largest retailer.
It is. But what I'm saying is
Walmart. Hear me out. Walmart makes more than $100 billion in Amazon. That's what a B. They make more than $100 billion. To Don's point, Walmart is competing with Amazon, but Walmart is also Costco's biggest competitor. They're not even the same thing, but Walmart is Target's biggest competitor. Walmart got like 3 ops. Walmart got like 3 ops, yo. They compete online.
Here we go, Jim. Here we go. Stock ops.
I like that one.
Ops.
Yeah. I like that one. There we go. We got it. The Stock Ops Show coming soon. We didn't give out too many business ideas. We didn't give out our steakhouse idea on Friday. Now we got the Stock Ops Show coming.
It's impossible to give out too many ideas.
No, but my thing is we can actually do this because we stay in the market and we can. And looking up companies is not a That's not a hard.
Now we need the 3 rounds. The first round.
It would just be more of the time to actually rumble.
So we got earnings and growth. What's the? We need three places to compare them at. Earnings, growth, and what else?
Put it out to the audience. What does the audience think?
Brand. How about brand? How about the brand?
Does the company promote? Like they have something? Do they have something that other people can't do? Like
that could be part of the brand. That could be part of the brand conversation.
You know what I mean? Like, what is their? There's some companies out here that I won't touch because I think they're unique, even though they're a great company.
I like that, Cedric. I like that, Cedric. There we go. I like that one.
But is that for the name or for the category?
No, for a category. But that could also fall under I
can't hear y'all. Something's going on.
Yeah, I see. I think that could fall under either growth or earnings, the balance sheet. Come on, it started doing when you went to this view, it started acting crazier than it did in the other view. Switch back. Or it could just be the fact that we've been on here. So, all right. So future outlook also could be part of the growth part. I like both of those answers though. But here, all right. So here's the 3: earnings. How much money are they making? The brand, and there's gonna be more things that fall under these trees. But the 3 big rounds: earnings, brand, and future outlook or growth. Those are the 3. How much money are they making? In terms of the brand, where does it have a moat? Where does it stand in its market, in the marketplace? And the third part is the future. So basically, that's past, present, future. If you really think about it, past in terms of what it's already earned, what it's earned, or present could be part of earnings too. So it's past, present, future. All right, there we go. Stock ops, corporate conversations. We got it, Jim. No, we're going with stock ops because they're the ops. Ooh. Blackstone. All right, so competitive advantage equal moat. This is correct. All right, y'all. This has been another great episode of our show on Sunday, right? Sunday Playbook. We appreciate the support. If you haven't yet, please join the village at blackwealthrebels.com. We have a lot of things coming in terms of not just talking about business, but culture. Kamari loves this screen, went back to this screen again. So, let me change the screen.
What are y'all doing, man?
I'm switching the screen because Kamari keeps
man.
I'm putting myself on the Summer Jam screen because Kamari keeps on going to the other screen. So, should we listen to the earnings call before the face-off? I mean, you could, but this is going to be whatever information they come up with that they want to battle with. You know what I'm saying? They may got they might do some research and have some personal information like they do in battle. They got personal angles, whatever they come up with. You know what I mean? It's going to be a battle, though. That's the battle we got. Matter of fact, Kamari, we're going to make a flyer for it, too, Kamari, the battle. We're going to put you on one side and you and Corey on the other side facing off.
Put the big verses in the middle.
Yeah, man.
I think Jamil's asking
we're going to tear Kamari's companies out the framework.
Pause. But I think he's asking, should everybody in the audience listen to
the companies, bro, not you.
Right.
I mean, you can. I wouldn't tell everybody too because I know that takes time, but because some of you might not be invested in it. Some people may just want to take a look at it and see what they come up with. But you can. Head to the village, y'all. Cedric, appreciate that. BlackWealthRebels.com. Join the village. BlackWealthRebels.com is definitely appreciated. Any ethical considerations?
I won't be using ethical considerations.
Wait a minute. What about cultural considerations?
I don't think any company.
What about cultural
I won't be using that either.
Now, hold on.
You can use it if you want.
But that may win him a point. That falls under brand, right? That falls under brand.
They might that does fall under brand, but what I'm saying to you, I won't be using ethical considerations because I don't think any company is ethical. So I won't be using it. I don't think any company is ethical.
First of all, I want to say thank you for the question because that is an excellent question.
It is.
Y'all, join the village. Like the old school deathmatch. Yeah, we're gonna create the flyer. We about to we created a whole new show, man. All right, go to Black Wealth Rebels, join the village, man. We love y'all. We appreciate all the support of those that support us on a daily basis, and always understand we definitely appreciate it. We are building something special here, and everything is appreciated. Go to BlackWealthRebels.com. Look out for the next episode of Stack Sats or Die Trying, which will be in the next couple days. Wednesday, Wealthy Wednesdays will be here on Wednesday for a short time. And then Friday, we do our live giveaway. Sunday, we back here live again, with another class on the market. Appreciate everybody for listening to the PE ratio. And, it is what it is, man. Love y'all. Take it easy. Peace.